as possible. Now that we've kind of gone over all these loans and you just don't know which loan is best for your situation, it is important for you to compare loan requirements, interest rates, and down payment options. For example, a couple with a strong credit score could certainly qualify for a conventional loan with a higher interest rate and a smaller down payment compared to FHA loans. This could actually save you money in the long run, especially if the conventional PMI is lower than the combination of FHA's upfront and monthly mortgage insurance combined. Conventional loans will actually give you the option to choose one mortgage insurance factor or PMI factor, such as a monthly factor, a single factor, split, whereas FHA will actually require you to finance upfront mortgage insurance premium, MIP, which is 1.75 upfront financed into the loan and 0.55 of the loan amount monthly with less than 5% down. If you get a 30-year FHA loan and put 3.5% down, you'll actually be paying for mortgage insurance premium for the entire term of the loan or as long as you have the loan. If you put down at least 10%, you'll actually be paying for the mortgage insurance premium only 11 years. Whereas for PMI on a conventional loan, it actually goes away after you get to 78% loan to value, which is 22% equity. So now that we understand how these loans work, we really have to go into the document gathering stage. It's really important that you gather all of your documents up front before you go under contract, because the underwriter and the loan officer and the processor really have to know what they're working with up front. The reason I'm bringing the processor and underwriter into this is if the credit score is on the lower end of where the FICO approval would be, then we're probably going to want to have your file completely reviewed. So the necessary paperwork that you have to gather for a true pre-approval are going to be your income, your assets, and your liabilities. In terms of income, we're really looking for tax returns, pay stubs, W-2s, or 1099s, any award letters for any type of fixed income such as Social Security, retirement, or pension. Then we're looking at assets, right? Assets are going to be your bank accounts. They're going to be your stocks, bonds, mutual funds, 401ks, TSPs, and any other liabilities or assets. And then in terms of the liabilities, we're looking at things that are not on your credit report. Any alimony, maintenance, or childcare, child support, anything that is going out that doesn't show up on your credit report, however, you have some sort of documentation on it. Certain loans do require us to count childcare, such as the VA loan for residual income, and then other loans like the conventionals and FHAs don't require us to use that at all. Typically, the biggest delay when it comes to getting your loan processed, that means you've gone under contract and you're going through the process. When you have a lot of conditions, and this is why I don't look at reviews sometimes when it comes to mortgage companies and loan officers that we bring on to work with us, because ultimately it takes two to tango, right? And we've all been down the process. If you're a loan officer, you ask your customer for 5 documents and then you get 3 documents. At that point, the delay in loan processing is truly due to missing documents. It's really important that you are working with your lender to understand the required documents, because documents are truly going to be specific to you. Everyone's not going to have the same exact documents, and truly all the documents that I rattled off, probably only 20% of those are going to be applicable to you. So now that you've gathered your document, let's talk money, down payment, and closing costs. Things to truly consider are, what is the minimum down payment versus the ideal down payment? And a lot of this is going to really be based on your budget and the different loan types. We've talked about the mortgage insurance factors. So if you're truly seeking like the lowest possible payment, you really need to talk to your loan officer about different ways to work with the private mortgage insurance if you're going conventional. So instead of paying monthly mortgage insurance, maybe you can do upfront premium and buy yourself out. In a higher rate environment, I truly don't recommend that. I would truly just go with whatever the minimum is and then look for that opportunity to refinance. And at that point, that's when I go all in with my chips and buy down that interest rate if you know you're going to be living in the home for a long time. If money is a concern, like how much you can put into it, at that point, I would talk to your loan officer about, hey, what is the lowest down payment option? And is there down payment assistance or grants or any types of programs out there that could help us out? So right now, we have on conventional loans for first-time home buyers, certain home buyers that are buying in certain areas and meet income limits can qualify for certain grants that are actually forgivable at closing. When you're talking to your loan officer and you're trying to weigh out the different options from down payment versus monthly payment, this is truly something that you need to work on. There's always going to be difficulty working on that larger down payment for a lower monthly mortgage payment. Before going into buying a home, it's really important to game plan for that money. Write a contract and say, hey, I'm going to start saving money throughout the process. That's truly not the most efficient way of doing it. You're really forcing yourself to do something. If you have the time and you know you're watching this video and it's going to be 1 to 2 years before you actually end up buying, I think you need to start budgeting. And the best way to truly budget is to start taking a portion of your pay out of your account and actually sticking it into something that you cannot access. Okay, so that would be always invest in your retirement plan, because if you're buying your first home, you could actually use that for a down payment, whether it be a loan or a one-time deduction, or putting it into a high-yield savings account or CD, because if you take that money out, you're not going to be gaining the high yield, and if you take the money out of the CD, you will be penalized. Let's kind of explore some low down payment and different programs and assistance programs that are out there. So USDA is the greatest example, right? USDA, yes, there is a rural restriction, so you have to put the address in through USDA, and then there's also a income restriction based on your household size and the composition of your family. However, with USDA, it does offer no money down for the purchasing of the house. And here's the real good thing about USDA if we go this route. If the USDA appraisal actually comes in higher than the purchase price, let's just say you have a contract to purchase the home at $200,000 and it comes back in at $210,000. You can actually take the difference between the $200,000 and the $210,000, that $10,000 difference, and you can actually use that to apply towards your closing cost. So there's another added benefit. I recently worked with a customer. He had some money saved up, 20% down for a conventional loan. And with that, we weighed everything out. It was like, okay, do we take the 20% down and eliminate all the PMI and get a payment? Or should we actually take some of this money and pay down debt, have less money down, so going into the house, his overall debt to income ratio came in lower? We actually opted for option 2. So instead of putting 20% down and having the lowest possible mortgage payment, we actually took 15% and use that to pay off debts. And with that elimination of $1,000 a month in consumer debts, the overall debt load that he had and the blended interest rate between all the credit cards, loans, and the mortgage was actually lower than getting the 20% down conventional. So always work with your loan officer. When I work with a customer, I always tell them we're truly married. You have to share everything that's financial going on, any questions or concerns that you have, almost like my spouse and I talk about every single night when the kids are asleep, right? This is the time that we start talking about the kids. The pre-approval process is very strenuous. However, getting pre-approved before house hunting is going to be really important because number one, it helps you determine your budget. Having that budget is super important, right? You know, you could say, yes, I want to buy a $300,000 house, but if you don't know what that monthly payment is and how it affects your budget, it's really going to be a bad situation in the long term for your financial goals. However, if you have determined, yes, this is in my budget and you get pre-approved, this actually shows the seller that you're really serious about buying a home. And it shows the listing agent that, hey, if I'm comparing offers and I'm looking at a pre-approval letter versus a pre-qualification letter, I'm probably going to want to go with a pre-approval letter because that loan officer has actually reviewed all the documents. They know all the income, assets, and liabilities. Whereas the pre-qualification letter is just, you've talked to the loan officer, you haven't sent in all your documents, and they're just taking all the information that you've given them verbally and saying, yes, you qualify. One of the things that really hurt the most, especially in this competitive market, is getting outbid on manufactured homes because your offer is contingent on loan approval. Now, what's one way that you can kind of get around all this? Because this is 2024, and with that, the market is a seller's market, right? So there's very limited inventory. Anyone that is selling is actually giving up their lower interest rate to go to a higher interest rate. So when they're taking offers, they want to make sure that they're getting an offer that's going to close right away. Before you make an offer that is contingent, it's really important to show the seller how qualified you are, right? So a couple strategies that I would use is this. Before you make the offer, get your house that you're selling under contract. Number two, work with a very reputable lender that can go to the listing agent and say, hey, listing agent, I've qualified the borrower. I've been in the business for X amount of years. Here's my NMLS number. I'm a top producer when it comes to this, and show the stats because really, talk is cheap. What's shown in writing, like your stat line, when you're looking at drafting for your fantasy football draft, you're not going to say, oh yeah, I like that guy because he talks a lot on the news. No, I'm looking at the stats. How many games do they play? How many yards are they getting? How many catches? How many touchdowns, et cetera, et cetera. So you should really treat your home buying process just like that. Contacting a lender that specializes in manufactured housing or the specific types of loans that you want is also very important. Not all lenders are going to be the same, right? Certain lenders are going to be retail, certain lenders are going to be wholesale. Certain lenders only offer certain products, and then other lenders, such as myself, we have multiple investors, 220 different investors. That's a lot of money that my company pays to get approved with these investors. However, because of that, we're able to give you different options that give you the best in terms of product, best in pricing, and the best in speed. Let's go ahead and talk about a customer that I helped out recently, okay? This is Crystal. In order to make our offer strong, they had a contingency. We're still kind of working through their process right now. So Crystal was selling her house that she financed with me 4 years ago. She's going to make some significant money from the sale of that house. And because of that, that's actually going to help them pay off a lot of debt. The reason that they are wanting to move is they want more land, and they've identified a manufactured home that truly fits their needs. This is a double wide, and there's a huge barn in the backyard. Crystal's idea of all of this is like, yes, I am increasing my monthly payment. However, one way that I can really look at this is my family and I, we're going to be able to enjoy a larger lot. We have more square footage now because we're going from 1,100 square foot house to a 2,000 square foot double wide. There's more land. So they're able to homestead, raise some chickens, raise some other animals, and they can get eggs and everything that homesteaders want to do. And the barn, her idea is to actually turn that into a barn-dominium. Now, what is a barn-dominium? The reason she wants to do this is it's going to actually generate additional income for her. So she can use it as a spot for photo shoots. She can use it as a spot where people can go and live in it as a short-term rental. And then finally, she's now creating that extra space that can actually be rented out long-term if she wanted to. So she's actually given herself a lot of different opportunities to monetize on the barn, as well as save money on food and other things by homesteading. So now that you're pre-approved, let's go down the journey of finding your dream manufactured home. First step that we have to take is we have to set your budget. We have to know what the budget is before you buy. Know your payment, the principal, interest, taxes, and insurance, make sure it's all included. How rate and down payment kind of affect your payments is really going to be a big key in your budgeting. So what do we need to do, and what do you need to know about your cost? So let's talk about the upfront cost. The upfront costs are going to be this. There's going to be an earnest money deposit that you have to put down to say, hey, I'm very interested in your house. I'm serious. And this is basically going to be deposit that says, if I don't follow through with the full loan and I just walk away and I'm qualified, I lose it, right? I can be sued. So that earnest money deposit is really instrumental in putting down, and the larger the amount, the higher your intent to want the house. The next thing is we have to budget for the appraisal. Appraisal is basically a person's observation of the house in terms of safety, sanitary, and structural. And the appraiser actually looks in a radius of where you're purchasing the house and says, hey, other houses of the same composition, the same size are worth this, okay? If there's any safety, sanitary, or structural concerns, these are the repairs that need to be done in order for us to get this value. And then finally, the third upfront cost would be the credit fee or credit report, right? Credit reports have increased a lot in 2024. That's definitely something that you should budget for. And I would say you should probably budget between $100 or $60 and $150 for the credit report. During the actual transaction, the upfront would be, hey, before we get the contract, now that we've gotten your contract accepted, what do we need a budget for now? We have to budget for a home inspection. A home inspection is an optional thing. However, with the home inspection, they will actually go into the house, inspect it from basically head to toe and say, hey, these are the issues that I find wrong with the house and you should negotiate these repairs. Home inspectors do not have to be licensed, but I would look at Google reviews. I would look for a national company because those national companies actually have really good training and they have really good insurance just in case they miss something. So it's really important to get that home inspection. Next thing would be totally optional on most loans except for VA loans, and that's the pest inspection. Pest inspection, we should probably budget anywhere between, I would say, $100 and $300 for the pest inspection. And this is all going to be based on the size of your house. However, depending on where you live, there's going to be different types of pests, right? You know, I live in Virginia, and in Virginia, as close to the water as I am, it's not if you're going to get termites, it's when you're going to get termites. So it's best to be precautious and know your environment, know your settings, and budget for that pest inspection during the home inspection and budget for the termite bond after the closing. Next thing would be survey. This is totally optional, but it's really nice to know what land you're actually purchasing, right? Having that survey in place will solve any property disputes in the future. And this truly is optional on most loans unless the appraiser calls that, hey, we may need to get a survey because right now, while I'm out here, I'm looking at this is where the property line starts and this is where their fence is. So your fence may actually be in someone's yard, and if your neighbor doesn't like you, they may make you take it down, and that could be a very, very costly expense. Closing cost and down payment are probably going to be lumped into the final things that you have to budget for during the transaction. You've proven to your loan officer that you have the money up front. Let's just say the interest rates went up. You need a little more money to qualify. So you can't get the closing costs from the seller. At this point, you have to have that contingency plan, right? A gift Am I going to dig into my retirement plan? Where am I going to get this money from? And then finally, after the transaction closes, what do we need a budget for? We need a budget for any contingency reserve or any minor and major repairs. How can we offset this contingency? Should we take some of this contingency money and maybe apply it towards like a home warranty that covers all of your major systems? Or should we take some of it and also put it into your insurance cost? Having that insurance cost and having that additional coverage is very important. A customer that I recently helped, she lives in a house and it's made of stucco or ephes. During one of her times of hanging up a picture, she started hammering the wall. Well, she popped a hole into the wall. When her husband went to go repair it, he looked in and he's like, hey, this is why it happened. There's a lot of moisture behind the walls. And the further they inspected, the more they cut out, the more they noticed that everything under the walls, under the stucco, was all bad. The house had to be rebuilt. So in situations like this, hidden costs like these are truly stressful and impossible to predict and really get out of hand fast. So expect the unexpected.